Welcome back, everybody. It is Money Mondays. You know what time it is?
It is 3:30 Central, where we do Money Mondays every Monday, 3:30 Central. Ben and I have been traveling all last week. We're traveling all this week, but guess what? We made it back on Monday just for you all.
Yes, we did. Just for our viewers. We love the show. We love trying to give back. What are we talking about today, my friend?
Talking about how to build your exit strategy in multifamily, how to think about the exit. I think a lot of people fixate on the buy, and that's what everyone stresses about, but people forget about the operations and then also the exit. The exit is as important as the buy.
Well, like I like to tell people, right? That's really where you make your money as an operator and as a GP, right? You know, yeah, you might make a little bit of an acquisition fee, but the real money is made when you increase the profitability of the asset and then ultimately hope that, you know, cap rates either stay where they're at or compress, or maybe if they don't, even if they expand, you've increased the profitability enough that obviously you're going to make a good profit on the end, which the GP gets a portion of, right? So it's important to think through this, folks. You know, one thing before we kind of get into this that I always tell people is when you're going to buy a deal, people get, again, so fixated on the buy and you know, getting the equity raise and getting the debt and getting it across the finish line. They don't realize that they just bought a 32 unit property in a tertiary market, right? You know, you think that you're getting a great deal. I bought that at an 8 or 9 cap. Well, guess what? That tertiary market, that 32 unit deal is probably going to be worth an 8 or 9 cap on the back end too, right? And why is that? It's because there's not going to be a lot of people looking to buy that deal in the future either, right? So you're wanting to look in places where you have a good pool of potential buyers, so that's going to allow you multiple exit strategies, right?
That's true. Or and if you bought that deal at an 8 or 9 cap and you're looking to sell it for a 10 or 11 cap, you just let us know.
Which would mean that you would hopefully make probably just a little bit less money than you would have on obviously if it would have been a 6 cap when you sold it.
Sure.
So, but point being, folks, is that not a lot of people are thinking about what is your avatar buyer on the back end, right? You know, I mean, we're trying to stick to more primary markets. Yeah, we'll still do a secondary market every once in a while, right? But the reason that we're trying to do that is because we're looking for a bigger pool of people that might buy the deal, and then that competitiveness, that demand drives the asset price up, right? Again, you're not going to get that in secondary and tertiary markets. So keep that in mind. There's your golden nugget for this show. How do you begin building that exit strategy, though? What does this process look like?
You know, I think you have to really sit down and evaluate the entire plan first and foremost, right? And based on your business plan, that's where you start to really reason about, can I make an exit in 2 years? Can I make an exit in 4? We just talked about a deal today that we had offered on apparently at the end of we're in May. We offered at the end of last year. It closed like 2 months ago, and now they're listing it for another $20 million.
I know.
So apparently their business plan was about 3 months. You know,
but so ridiculous.
But you know, ultimately, it really depends on your business plan, folks. We're trying to upgrade 200 units. Guess what? We're not going to upgrade 200 units in 3 months. It's not possible, right? So you really need to sit down, evaluate what you're trying to do, and then ultimately tie it back into where you think the market's going to be and what valuations you think you can get, right? Yeah. So all these things go hand in hand together to where, okay, hey, we have our soft target at this thing. If this doesn't pan out, we can do A, B, C, right? You want to have your exit strategies. You want to sit there and kind of evaluate, and it's all numbers driven, right? We don't just, you know, maybe not B, but you know, we don't just kind of hold our finger to the air and decide, you know what, we're just going to sell, right? You need to actually sit down and work through it and do it at the right point in time. At some point in time, you get to the point of diminishing returns, right? Yeah. We've talked about this on some deals where.
Let's. What do you mean by that, though? Because I think a lot of people get, oh, I'm going to hold it for 20 years or whatever.
You know,
right?
And it's a point in time where essentially you have so much money tied up into it that ultimately, you know, your returns are nil, right, or very low relative to the amount of money you have in it. And actually, I'll give you a real example. We know somebody that owns a lot of houses, right? His problem is he owns a house that's free and clear, right? So his actual cash on cash return is abysmal. Right? But at the same time, it's hard for him to sell them all, right? And there's tax implications, all this other stuff. So that person's kind of in a bind, right? And so it's a point of diminishing returns. We're on a deal that, hey, we can continue to upgrade deals, but guess what? If we're already getting the rep pops, and maybe you can do all that work to get that upgrade, but you're only getting a $25 increase because you already got the 100 off of just the normal rent appreciations, well, then it probably doesn't make sense. So, you know, it's not a one-size-fits-all, folks, about evaluating, iterating, and then figure out what works, what doesn't. But ultimately, to get you to that finish line inflection point is what I like to call it, where, hey, at this point in time, it makes sense to do a refi or sell. Yeah. We got our occupancy where we need it. We got our collections where we need it. We got everything humming along that we know we could do a refi, get the returns, the money out that we want, or we could do a sell and obviously hit the total returns that we're looking for.
So just to kind of, you know, I guess add on to what Ferris is talking about, folks, right? You're going to take a value add property, right? You're going to put money into it. Let's just call it, you're going to put $2 million into it, right? And you're going to ride that appreciation, right? You've now increased the value of the property through obviously increasing, the rents and, the amenity sets. You're going to drive occupancy up. All those good things happen. That's why we put money into those deals, right? But after a certain amount of time, let's just take, we take a Fannie or Freddie deal, right? Sometimes you can get a supplemental. It's not always guaranteed. Sometimes you're not even going to get that much. Right? A supplemental in this case, folks, just for newer viewers, is almost like a second note. Well, that's exactly what it is, actually.
Almost.
But it is a second note. But point being is, you're going to get to a point where you've already put the money in. You've already got the juice. Right, and that's why people. It's not necessarily the market's been hot, but it's also because you're gonna sit back and say, unless I somehow pull more money out or put more money back into the deal by having a capital call or whatever it might be, which nobody wants to do, I'm not going to get that additional juice. And in the meantime, people are selling and transacting constantly, and maybe by that point you're in year 4, 5, 6. All of your neighbors have already traded 2 or 3 different times since you've held on to it, and they're way above you. Right, and so you're getting that diminishing return on that initial investment, right? And so that's typically when you're going to say, okay, it's time to sell, right? And now that could be very, very early on, call it 12, 18 months, or maybe in this case, which is a stupid deal, 3 months. Typically that's going to be in the 3 to 5 year mark, right? Unless you're prepared to do some kind of a refinance or a supplemental to put more money into the deal, you're always going to have to. These deals eat money, folks. They're always constantly needing, there's deferred maintenance, there's constantly going to be upgrades because you have to keep up with the market, right? So be keeping that in mind, right? That there's that 10-year hold that you're going to have, probably going to want to sell that thing within 5 to 7, and that's something that we always kind of keep in mind. What's the market going to look like in 5 to 7 years? So that's one of the questions that had come in before this, right? What is the typical hold times? 5 to 7 years. And again, that's just, you get to a natural progression and an inflection point where you say, it's just time to sell, right? Now the market has been hot, so it's been more like 3 to 5 years for us, but there's anything in between is typically what we're looking at, because it also takes a little bit of time to actually execute on your business plan too, right? You're not going to come in and update 150 units, year one, right? Maybe you've got that much turnover, which I hope you wouldn't, or maybe you got down units, which I hope you wouldn't have 150. But if you did, maybe that'd be the only reason that you'd be able to do that, because there's just not enough turnover at a property that you're going to be able to do all of that and execute on your business plan and then raise rents in 1 year. It's typically a 2 to 3 year process. Then you're at, okay, stabilization. Then you decide, hey, what is it? Do we sell? Do we keep it? Do we ride it out? What do we want to do? Right? All right, so moving along. Is there a chance you sell earlier or later than the projected, and what is the deciding factor? I think we just went over that, right?
I think the answer is it's everything is always in flux.
It's an opportunistic. You got to be opportunistic.
Everything's cyclical, folks. So you cannot, if you're investing with someone who is basically one size fits all, and this is a strategy, this is the only strategy, and nothing else but the strategy. That's a problem.
Yeah, you got to be opportunistic, right? Sometimes the market's going to get hot. Sometimes the market's going to slow down, right? You need to be in a position to say, okay, hey, based on what I'm seeing in the market, I'm going to pivot, and this is what we're going to do, right? That could be sell, or that could maybe be holding on, right? You say, oh, well, originally it was a 3-year hold, but the market's a little slow. I'm not going to get the pricing that I want, so we're going to hold on to it for another year. Don't feel bad about that, folks. You need to be able to pivot and adjust according to the market cycles, right? So what conditions are you underwriting on the exit, right? We've talked about this many a times on the show in the past, right? We typically always underwrite it 15 to 20 basis points per year per hold based on the stabilized cap rate going in. So what do I mean by that? I'm gonna break it down, right? If I'm buying it and the stabilized cap rate here in Houston for a Class B property is, let's just call it 4.5, right? Which is probably about right, maybe 4.75, right? But we're gonna call it 4.5 just to keep the numbers easy, right? Then I'm gonna say I'm gonna increase it 20 basis points for every year that I hold on to it. And I'm gonna hold it for 5 years. That means that my exit cap, the value that I would sell it on the back end, would be 5.5. Right now, people are going to say, well, but maybe cap rates aren't really 4.5 right now. Maybe they're 4. right? I'm basing it off of the stabilized, what I feel the cap rate should be, regardless of how hot the market is, right? And sometimes when you're buying it, the going in cap rate's a little bit skewed. Maybe it's not running to an optimal, degree. There's something off. There's down units. There's just something that's not working. So the cap rate's lower artificially. So you got to say, okay, in that case, it's not really a 3.5 cap. Really, that market's 4.5, and then I'm basing it off of that, right? So that's how those are the assumptions that we're making, that cap rates are going to expand at some point in the future. And, we're typically doing that 15 to 20 basis points per year hold, right? How do you minimize capital gains? Oof. So we obviously had a lot of those questions last year because we sold.
An investor that asked us that today.
Well, how many deals did we sold 6, 7 deals last year?
6 deals last year, and then 1 at the beginning of this year. So
yeah, and then we're selling another one too. So this has been something that we have constantly talked about. We know some people's strategies. Obviously, 1031s, which within syndications you can do. They are obviously a lot of paperwork. There is a lot of coordination. It takes some time to set up. So don't get caught up in the fact that you can't do it. I'm just going to tell you it's not easy, right? But it also depends on where you're at, right? Are you an LP or are you a GP, right? If you're an LP, right, what you're trying to do is you're trying to reinvest those gains into something that's going to have losses, right? And same thing that we do on the GP side, right? Is that instead of taking a 1031 strategy, we're just essentially buying deals. Obviously, they're underwritten, they're great looking assets. And then we're taking the depreciation and the cost seg from year one, right? And that's offsetting the capital gains that's happened that year. Now, we always encourage our investors to redeploy their money as quickly as possible so they can do that too. But it's funny, every fourth quarter, we get all these people.
Or Q1, which is a little bit too late.
Yeah, or people that forgot about it, and they're like, hey, I want to try to get money in. But they're coming to us because they want to invest in their deals. Why do they want to do that? It's because they want those losses, right? They've come off of a capital gain situation, and this is, obviously, capital gains in any kind of real estate, really, right? And they're trying to offset that with the depreciation and the cost segregation. If you don't know about those concepts, we're not going to spend time on it. Look them up. There's a lot of good information. We use Madison Specs for our cost segregation studies. They're great guys over there and girls. But that's how we minimize the capital gains that we have to pay taxes on, right? Everybody's tax situation is different though, folks. So check with your CPA, check with your lawyer. I am not a financial advisor, so don't take that as professional advice, right? So how soon after the sale do investors' distributions occur? What is the distribution process and timing upon sale? All right. This is a good question because this has obviously come up over the last 12 months since we've been selling deals. There's a wind down process, right? So when we go and sell deals, it's not like, oh, we've got $1 million in the bank and we're going to distribute all that $1 million the first week, right? There's accounts payable. There's things that need to be reconciled. There is obviously insurance refunds that have to come in. There's utilities that have to be paid, and there's utility deposits that you might get back, right? There's reconciliation across the board. That takes time. Typically how we do it is in 3 tranches, right? We're going to give your initial invested capital back.
And this is what we do, right?
This is what we do.
Rule of thumb or anything like that.
Yeah, and people do it all kinds of different ways, right? Just after selling, I think 12 deals at this point, this is how we're going to do it, right? We're giving the invested capital back plus the preferred return, right? Then the second, call it distribution, is going to be the big one, right? Where the bulk of the money is going to be done. And that first one is done probably within 2 weeks. The second one is done typically within 2 months. And then there's going to be a third one, typically a little bit smaller than the second one, where all of the reconciliation, all of the wind down has been done, all of the tax prep has been done, right? And it's going to be your final K1. And that's typically within 6 months of when we sold. Right? So it's going to come in 3 different tranches, typically from 2 weeks all the way up to 6 months, right? And that's typically how we do it. Again, like Ferris had mentioned, people do it differently. We're open to suggestions on doing it better, but we found that this is probably the best way to do it just based on the realities of the wind down process. So, that's typically how we do it. And people have appreciated that. And you just obviously got to set the right expectations whenever you're going into the sale, that this is what it's going to be and this is how long it's going to take. Right, so all part of the exit. The exit's a great thing, And I would say the one other point here that I want to mention: if you figured it out that hey, I want to sell, there's also a let's get the asset ready to sell process too, right? Let's throw on some good landscaping. Let's maybe paint a few things. Let's go around and polish up the asset. Let's make sure that our financials are all straight and good and looking great, right? There's a process to all of that, and that's also just to put your best foot forward when you go to market for something. Right? And the broker is going to tell you the same thing. It's just like you're trying to sell your house, the broker comes by or the real estate agent comes by and says, oh, you need to clean this out and rearrange that, and we need to stage this over here. It's the same process, just on a bigger level. Right? So that's something that you need to be
work that I think a lot of guys don't do that.
No, they
don't.
A lot
of guys just kind of stumble into it.
And it's a process.
Talk to your property management company, folks. Right?
Well, that and talk to the broker. Broker's going to have some good ideas too, right? They're going to say, don't worry about painting. The next guy's going to do that, but definitely fix this, and this. Right? There is an art to setting the right. I guess putting your best foot forward is what I'm trying to say. So something to keep into consideration when you're going to sell your deal, right? You want to get maximum dollars when you go to sell. That's when the GP makes their money, not on the front end, it's on the back end. So, man, I got through that pretty quick.
Exactly.
Open Q&A. What do we got?
So Trevor says, happy Monday. Ben Ferris, thank you for always sharing great info. You bet. Thanks for all your support.
Yeah, man. Yeah, for sure.
Let's see if anyone has any comments, questions. Please leave them. We will
Everybody
answer them
knows
here
how to
live.
exit their deals. Wow.
Most people are still worried about buying, Ben. Focus on the buy. Sale comes later. But it's important. And the other thing too I'll add that we kind of didn't talk about is, if you're an operator, right, timing your exits is critical, because not only can you get your investors excited and pumped for the next deal, right? You build your track record. And you make an exit. Some people are really about not making an exit, and they miss the wave of the market, right? Some people are just, as operators, they just want to milk it for fees and don't want to exit. They just want to keep bringing in the asset management fees or whatever small fees that are coming in.
It's
and really,
pennies,
I think, for us, it's short-sighted. It's better to keep your investors happy, maximize returns, on to the next one.
Yeah, I think it's all about cycling money too. I think people need to realize that, right? From our perspective, it's all about getting some points up on the board and recycling investors' money and getting them some returns, and then allowing them to continue to build their wealth, over time, right? And so, yeah, you can't be short-sighted on both sides, right? You can't hold out just because you're wanting to, extract some more fees on an asset management fee, or you're trying to, be smarter than the market, right? The writing is on the wall. Things probably are going to slow down a little bit, but at the end of the day, right, positioning your exit is, something that you should be planning out 3 to 6 months ahead of time. And, obviously working with your broker, working with your property management company, and doing it the right way.
All right, so we got another comment. Says, the design of a strategy depends on the goals of the company, but also is necessary local advisory to define the correct strategy. Can you help me get in contact with expert advisors in real estate?
I think that's, the expert advisors in real estate, depending on the market, you're going to be your property management companies, right? They're going to be able to tell you about the markets, and the brokers will tell you to an extent, how active the market is, how many people are trading, where cap rates at. So if you talk to the brokers in those markets, you talk to property management companies in those markets, you're going to get a good feel for the market itself. How transactional is it? Because there's going to be some markets that are very liquid, that people are always buying and selling, and then there's going to be other markets that are a little bit slower. Right, and it's typically follows just how popular that market is, right? So you can get a sense of how good the market is depending on how many transactions are happening right then and there, right? But good question, but check with your property management company, check with the brokers.
All right, we got another question. Did you have tips for a first-time investor looking to house hack a multifamily?
I think multifamily, well, Brandon Turner's got some good books on this, right? Yeah. I think, check out his stuff, his earlier stuff. I think he did a master lease and some other kind of cool things, right? Typically, when you're talking about 100, 200, 300 unit properties, there's just not really any way that you can do that. It's a commercial transaction. It's a business transaction. You're not going to be able to do that. Now, there's stuff to be said like, hey, you want to get a quad or, get, triplex, something like that, where you're going to live in one and you're going to be able to rent out the other two. People do that all the time. Just depends on your market too. There's not a lot of that stuff down here. Here in Texas, obviously it's bigger, so they build this stuff bigger. But I know on the Northeast and some other pockets that there's a lot of, fourplexes and triplexes. So look into that. Right, get yourself a, maybe an FHA loan or a VA loan, depending on your situation. See if you can get in for as little money as possible. And the whole business model would be to rent out the other units and have them pay for your mortgage, right? Now, again, the one downside of that is that you're the landlord and you're living right next to your tenants. So take that into consideration.
But you don't let them know you're the landlord. That's the real trick.
Well, yeah, I mean, there's probably ways that you can mask that a little bit, but at the end of the day, there's still a concern, right? So take that into consideration. But the benefit, I would say, probably far outweighs that concern. But it's a good question.
All right. Otherwise, Amanda asks, do you generally assign or hold on to a portion of your CapEx budget to the sale process up front?
Sale process. I mean, typically, we've got reserves and we've got Capex.
So yeah, I mean, I don't know what do you mean by assign, right? But typically, I mean, cash is cash, it's our cash. It doesn't go to the next buyer, right? First and foremost.
I would also say that there's always a contingency. So sometimes there's a little bit of money that, hey, you get in, you buy the thing, and then you've got to reallocate.
I know what she's saying.
Is that what it is?
She's saying at the beginning, whenever you're planning the CapEx budget, do you keep $500,000 on the sideline, knowing you're going to beautify the property right before the sale? That's what I think we were saying.
I mean,
you could.
You absolutely could. Right?
We don't really go to that level of detail. Typically, we try to keep the property looking good, and then once you're at the finish line, you're spending another $100K, right? You don't need to have this overly complex budgeted CapEx.
Yeah,
you can just pull it off of cash.
If you're spending more than $100K on the exit, then the property's probably in a tough spot.
That's what she was trying to say.
Yeah. So, you absolutely can do that. Typically it just depends on how long your hold time is. Are you gonna hold back $100K for 5 to 7 years?
Yeah, I'll say this: if we're flipping a property, we know it's going to be a 1 or 2 year. Yeah, up front we
probably do that.
We would plan. Hey, we know we're going to do, because everything we're doing is to get it pretty for that 2 year mark, right?
That's the pop.
But if we're holding a deal for 7 years, right? Typically, it's okay. Let's make it attractive for tenants now. Yeah. Then in 7 years, evaluate where we are and what we need to cure.
Yeah. So, but that's a great question. But yeah, no. Again, it just depends on the whole time. I think. Cool. All right. Is that it? No more questions?
Keep going.
All right. We're going to get into this. Oh my gosh. The Sunbelt Diversified Portfolio. Come check it out. Interestform.disruptequity.com/Sunbelt. This is a diversified portfolio of 3 different properties: Austin, Daytona, and Atlanta. We're really, really excited to roll this out. Check it out. Great returns, good diversification, and very high growth markets. The Sunbelt Diversified Portfolio.
We're excited. We're about 60% raised plus. So
yeah,
we're rock and rolling, and I think that'll close out hopefully the next couple of days.
Yeah. So definitely filling up fast. Check it out at that link. We'll drop it into the comments as well. But can't do a Money Monday without talking about MFIN. Oh my gosh. The Multifamily Investor Network, and we're doing it in
Seattle.
Oh, Seattle, my friend. And that is July 23rd. Great time of the year to get out there. We're really, really excited about that. We're going to have some great keynotes, some great panelists that we're going to be announcing here in the coming weeks. Tickets are already being sold, so get in there, check it out, www.mfinvestornetwork.com. Put in DISRUPT for your coupon code, get $100 off. Prices rise.
Will go up every week on the week until we reach $1 million.
Oh my gosh. They're not gonna get that expensive. We'd still
know.
give you a $999,000 or $500. Well, we'll give you a lot of money off if it was ever that much. But check that out. We're really excited about it. It should have 300 or 400 people there, I'm assuming. And it's a great time of the year to be in Seattle, right? So what's coming up next, my friend? What are we talking about?
Overpaying for a multifamily property in 2022, and if you guys figure that out, you just let us know. Nobody's got a crystal ball, but there are some indicators, some things to think about as you're buying, right? And you want to always you can't time the market, but you want to always feel like you've got a good deal, right? Relative to everybody else, you're getting a discount and you have that upside. So we'll talk about that next week, and that'll keep us busy.
All right. See you guys then for another Money Mondays.
Thank you all.